Welcome to MoneyWise on 938 Live. Joining us, as we always have, is Dennis Ng. He's the author of Mastering Your Personal Finances. Last week, we ended off the show by talking about the possibility of buying low and selling high. So I had to bring Dennis back to tell us or ask him how you could buy or sell high in the equity market. Good morning, Dennis.
Good morning, Keith.
Dennis, buying low, selling high, possible? What do? You go to the STI index and you take a look at all the 3.5 cents, 2.5 cents, or 0.5 cent shares, and is that buying low, Dennis?
No, not exactly. When you look at the stock, you can't look at the stock price alone. So whether you are paying high price or low price, you need to compare to the earnings. So one of the ratio you can look at is actually price-earning ratio. So you compare the stock price to the earnings the company have. So, for instance, if a company has a PE ratio of 10 times, means that it will take 10 years for it to return you back the same amount of money in terms of what they earn, or in other words, 10 times means that the return is actually about 10%. Yeah.
Okay.
So basically, the lower the PE, typically it means that the cheaper the stock, and vice versa.
So it sounds like a lot of work that goes into your planning of this purchase of your stock. Does it mean that you're basically searching constantly for undervalued stocks and undervalued companies?
Yes, I'm afraid to tell you that PE ratio is only one of the ratios that you can look at. Other ratios you can look at, including dividend yield, the price to book ratio. Of course, you also need to observe and look at the economic growth figures and the economic prospects. And last but not least, you need to look at the chart. You need to look at the historical prices of the stock and so forth, and whether now the prices is too low or too high in comparison, let's say, to the last 10 years price trend of this stock.
So to generate a decent yield, what do you need to do? And how many perhaps counters are you going to have to buy if you're going to do this on your own?
Actually, it's possible to possibly just buy about 5 to 10 stocks, And actually, doing homework is now very simple because now there are websites you can subscribe to, and they will help you calculate a lot of these ratios. So you can just actually have your own criteria, and thereby you zoom into those stocks that meet all those criteria, and then you can make your pick, and possibly you can buy 5 to 10 stocks. That's how you can reduce your risk.
But you're supposed to hold this for the long term. Supposing the price of the stock has appreciated substantially, what do you do? Is it time to sell, or do you have to hold it for that 10-year period?
I used to believe in buy and hold, but now I no longer believe in buy and hold because I've noticed that market goes through a cycle. So every 4 to 5 years, there will be a bull market, there will be a bear market, and so forth. So no point you hold a stock when the price is very high and continue holding it, and then in the bear market it will crash down to very low levels. Let's say, for instance, GBS in 2007 was $25, and then it hit until $6.50 during 2008, and now it's about $14.90. So if you have held the stock through thick and thin, if you bought it at 25 back in 2007, until now you're still losing money.
Okay. All right, let's do a flip change and let's talk about perhaps the property market these days. That's people look at that as the gold mine these days. If I can flip a property, I would never kind of earn that money ever in my life. So how do you buy low and sell high in something like that, given the current state of the property market and the current prices?
Actually, a property market, to know whether the prices are high or low, one simple way is to look at this thing called the rental yield. So basically, compare the rental income divided by the purchase price of the property. And I would say that typically rental yield should be at least of about 4 to 5%. Then in that case, you would say that you didn't buy too high. So I have to say that based on this, currently some of the properties in Singapore, they only have a rental yield of about 2 to 3%. And obviously some of these properties, the prices are already too high. And if you buy now, then the only hope you can have is buy high and sell higher. But what if you buy high and possibly in 2011 or 2012 the price drop, then possibly you need to have holding power to pull through this difficult period.
So where do you scour besides, the rental yield? Do you go to property auctions, perhaps, if you are a serious investor?
Definitely, but in a hot market like currently, the market is very hot for properties. There are no bargains, basically. So even if you go to property auctions, you're not going to find bargains because people are not desperate to sell. Those auctions, most of the auctions now are conducted by sellers who want a higher price and not by banks, mortgagee sale whereby they foreclose on the properties. So typically you can find a good bargain if it's a foreclosure sale, but you will not find a good bargain if it's a seller going to the auctions themselves.
That, of course, was Dennis Ng. He's the author of Mastering Your Personal Finances. Of course, Dennis will join us again next week on Money Mize. If you have any questions that you'd like Dennis to address, please feel free to drop me a line at fresh@938live.sg. Thank you, Dennis, for joining us this morning.